LOWE'S Stock, ticker symbol LOW. This stock is up 6% on the year-to-date chart, underperforming the SP 500 slightly. And LOWE'S beat on both the EPS and revenue, but for the upcoming earnings, all analysts expect a miss. And people like LOWE'S for many reasons, one of the main things being the dividend. It is not only the 1.9% dividend yield, but the 18% dividend growth rate and 60 consecutive years of dividend increases. If we look at the past 5 years, we see that LOWE'S beats the SP 500 by a decent amount. So could this be the perfect time to buy LOWE'S stock? Well, by the end of the video I will give you my 3 price targets, so make sure to stay tuned and see how I build up to these price targets. I'm very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So what does LOWE'S do? LOWE'S is the second largest home improvement retailer in the world, operating more than 1,700 stores in the United States. When we dive in the earnings report, we see that net sales was reported at 18.6 billion. Down from 22.4 billion year over year. Cost of sales went down in the same ratio, and because of that, gross margin is pretty similar. Operating income improved significantly, which is a good sign. Looking at the EPS, it also grew a decent amount. To me, this looks really good. We also see that dividends are covered very easily. For the full year of 2024, LOWE'S expects sales to be in a range of 84 to 85 billion, which means another year of revenue decreases for LOWE'S. It is also expected that comparable sales will go down 2 to 3% versus 2023, also not a good sign to me. Operating income will be around 12.6%. This is a decrease versus the 2023 number of 13.4%. Also not a good sign. EPS is expected to be in a range of $12 to $12.30, also down versus 2023. And I want to zoom in on the comparable sales a bit more. For LOWE'S, it is really easy to add more revenue by opening new stores, but you want the existing stores to grow as well. In the recent earnings, we see that comparable sales is down 6%. Both the average ticket value and online sales declined as well. And interestingly enough, all ticket sizes from less than $100 to more than $500 decreased. And now that we know a bit more about the company, it is time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analyses every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue diving into the fundamentals. LOWE'S is a 133 billion market cap company. PE ratio is at 17, indicating they could be undervalued. Later in this video I will show you my 3 price targets for LOWE'S stock, so make sure to watch until the end. Revenue is at 86 billion, and in this graph we see that revenue went up in the long run. During lockdown periods the revenue skyrocketed. Most recently it is coming down big time. Margins are going up and down a bit since lockdown periods, but in general it is going up. To me this looks really good. EPS is pretty much the same story as the margins and the revenue. Nothing really special to add here. Analysts expect that EPS will decrease in the coming years. Especially 2024 is going to be a tough year with minus 5% growth expectations in EPS. After that they expect EPS to grow at roughly 10% per year on average. For the revenue, analysts also expect 2024 to be a tough year with minus 11%. After that things start to recover and we're sitting at roughly 3% growth per year. Return on assets is sitting at 18%, which is a great number. Return on equity looks really bad, and the most important number, return on invested capital, is sitting at 42%, which is an insane number. It is lower versus the 5-year average, which makes sense since the lockdown periods really boosted the company. Current ratio is at 1.23, which is a great number. Nothing that really worries me a lot here. And right now Lowe's has 14 billion in debt. I prefer companies that can pay down at least a big chunk of their total debt with the total cash. Lowe's has 921 million in total cash, so they can't pay down a big chunk of their debt. To me, this doesn't look any good. So it is very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And here we see that free cash flow went up in the long run. The recent decrease doesn't worry me that much since the lockdown periods really boosted the company. Shares outstanding are decreasing, which is something that I really like. When shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 1.9%, which is a decent number. I would love to see a higher number, but it is still looking pretty decent. Annual payout is at $4.4 and payout ratio is at only 33%. I prefer 50% or lower, so right now they have 67% left in cash to buy back shares, pay down debt, do acquisitions and all other things. The 5-year growth rate is at 18%, which is a great number. They have increased the dividend for 60 years in a row, which is also really impressive. And if you take a look at these numbers, the dividends paid since 2012, you see that Lowe's did increase the dividends at a high pace. Payout ratio is a very important metric with dividends. It tells you if the dividends are safe. In here we see that historically it looked really good. In this graph we see the expected dividends in 2024, 2025 and 2026. Of course this is an estimation and can be highly impacted by results, but it gives you a rough indication. It is expected to grow at historical numbers. Overall these dividends look really good to me, but how about the historical returns? I decided to compare Lowe's stock with the overall market, in this case the S&P 500. Next to that I added Home Depot. On the 5-year chart we see that Lowe's beats the S&P 500 with a small difference. Home Depot had the lowest return with 90%. And keep in mind this is including dividends. On the 1-year chart things look pretty different, since the S&P 500 returned 27% while both Lowe's and Home Depot are seeing much lower returns. On the 6-month chart we see that all 3 of them had nearly the same return with 18 to 19%. On the 1-month chart we see that all 3 got a negative return. However, the S&P 500 is sitting at only minus 1%, while the other 2 are seeing much lower returns. Bottom line, Lowe's was the winner in the long run, but in the short run the S&P 500 wins. So, could this be the perfect time to buy Lowe's stock? Well, let's check the 3 price targets that are created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 2, 3 and 4%, based on historical performance, their own outlook, but also because of the analysis. For the profit margin I'm putting in 9, 10 and 11%. For the free cash flow margin I'm putting in lower numbers. For the PE ratio I'm putting in 15, 16 and 17. For the price to free cash flow I'm putting in slightly higher numbers. My desired annual return is 12.5% since I can get an easy 10% average annual return with owning an ETF. Right now Lowe's stock is around $232. I hit analyze and we only see red numbers. We have a low price target of $105 to $153. We have a mid price target of $136 to $188 and we have a high price target of $173 to $230. And to me, the high price target is the most justified here, telling me that this stock is still overvalued. And which price target do you think is most justified? Let me know in the comments down below. My final conclusion on LOWE'S is that it is an amazing company with a great historical track record. Most fundamentals are looking really good, besides the growth right now. And that is really one of the main concerns I have. Luckily the margins are improving, and that is where the value is right now. From a dividend point of view, you got a great dividend paying company, high growth and 60 years of dividend increases. The yield is also looking pretty decent. From a value point of view, I don't get too excited. The lack of growth is really holding me back right now. And with the stock being overvalued based on these numbers, I will add them to the watch list. And whenever the price drops significantly or the company improves the business, I might consider buying LOWE'S again. And remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and it did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.